2, 1. Hello, ladies and gentlemen. It's Monroe Mann here. And we're going to be doing some more talking about investments and also how it applies to your life as well. First, I'm putting up the lights a little bit high. It seems a little dark in here. For you new guys, if you're just watching for the very first time, please come and check out my channel for comedy, music, investment advice or counsel in any way, legal information, and music. All right, so what are we going to be talking about today? I'm reading this amazing book, Principles by Ray Dalio. And who's Ray Dalio? Ray Dalio is one of the world's, if not the world's, most successful hedge fund manager. And what is a hedge fund? A hedge fund is a fund, it's an investment fund, typically for people with a lot of money who want to make more money through more risky investments and also through access to investments that normal people don't have access to. What's up, Carly? How are you? Hope you're excited for an 8 p.m. educational live stream learning about investments and Ray Dalio's principles. And it's called being an entrepreneur. What's called being an entrepreneur? What are you talking about? Oh, you're talking about being a hedge fund manager. Yeah, a hedge, yeah. You're right, Carly. And I'm glad you make that point, because for you to invest time, money, energy, thoughts into creating a business, you're basically creating your own hedge fund. But the difference is, like with a business, an company, you're putting everything into that company. But we'll talk about how this whole concept that we're talking about, Ray Dalio calls it the Holy Grail principle of investing. And it's something, of course, it's something that's been around forever. And everyone's learned over the years, don't put all your eggs in one basket. But it's nice to hear it from somebody as successful as an investor as Ray Dalio. Because this guy, oh my gosh, mind-blowing how successful he is. And again, all of you need to read this book. It is so good. It's not necessarily a book about investments. It's principles for life that he's learned from all of his experiences as a hedge fund manager. What's up, Carly? It's the only thing I learned from school, which is lame. Well, Carly, that's why you're in school with your best teacher, Monroe Mann. You're going to learn more. How you doing, Arthur, I guess? How you doing, Arthur? Привет. Здравствуйте. Приятно, I forget how to say it. Приятно bekomicha. I don't remember how to say nice to meet you. White Park, how are you? Great to see you. So I posted in my community in YouTube, I posted a photo. And how you doing, Caitlin? This is the photo that I posted right here. The Holy Grail. And I know this doesn't look very fun right now, but I want you to look at this, and I'm going to explain this really quickly. Look, over here is the annual portfolio standard deviation. And over here is the number of assets or alphas in the portfolio. Okay? And this is showing you the probability. Well, before we even get into that, because I don't want to scare you guys already. Let me just go over what that was right there. Let me just explain that. Let me show you again. Look at it. Don't get nervous. Okay? Look at it again. Annual portfolio standard deviation. So what that means is, when we're talking about standard deviation, what does that mean? In anything, it's how likely is something to go outside the norm. So if, let's say you have an average, for example, let me give you an example using my YouTube live stream right here. my average number of people on a live stream, I would say, is 10. I wish YouTube would actually give that statistic, like what's your average number of concurrent viewers. So I'd say the average is 10. But the standard deviation is how many people show up on either side, lower than that average of 10 and much higher than that average of 10. And why is this important? Because when you're thinking about your investment returns, and think about this I'm going to talk about how this applies to your life in a moment, but you got to understand how this first works when you're applying it to investment stuff. If you're getting an average of 10% return per year, that's good, let's just say. But that's not so great if the standard deviation sometimes during the middle of the year, you've lost 90% of all your money. Because then if you need that money after 7 months, oh my gosh, you've lost pretty much everything. So you would, ideally, in the best case scenario, you want to have a portfolio that is, 10, 12, 20% return per year with a very low standard deviation, because it's going to be very, very, very consistent on a month-to-month basis. So let me just look here at these comments here. I was texting a guy friend and he asked what I had for dinner, and it was corn dogs. And that's great, Carly. Uh-oh. Very naughty. Yeah, autocorrect can cause you problems. I love how we got down to, we started with one person, Carly. We went up to 12, and then I started talking about standard deviation, and we went down to one person again. But let me show you this again, too. And if you can stick with me, this is going to be very enlightening for you. So look at this. Very basically, the probability of losing money in any given year is basically, look, it's going down 40%, 39, 38, 35, all the way down to 11% down here, right? What reduced your probability of losing money in a given year, you'll see, is when we reduce, and also, what does that mean? The standard deviation goes down as well. So the standard deviation is correlated with the probability of losing money. If there is a very high standard deviation, up here, let's say 10%, guess what? You're looking at a likelihood of losing 40% of money in a given year. What this is talking about here is, now look around here, the number of assets in a portfolio. So there's one. If you only have one asset, if you own one stock, the standard deviation on average is going to be 10%, which means the likelihood of you losing money if you put all your money into that one stock is 40% in any given year, right? But look, as you increase the number of assets in a portfolio, the probability of losing money in a given year just goes down dramatically. And you can have it where there's an actual, now this 60% correlation is also regarding to the market. 60% correlation, okay? You can reduce the correlation down to 0 by simply increasing the number of assets in your portfolio. So White Park is still here. Good, and Carly's still here. You guys actually are going to learn something awesome because you stuck with me. Now, this he calls this the Holy Grail. It's not even just the Holy Grail for investing. He explains this is the Holy Grail for success in life as well, not just the success as an investor. So, we've got Booplop back again. How are you? Yeah, this is Monroe. How are you? The big question is, are you also Mr. Blue? I wonder if that's the same person. The whole idea that with this is, And this is what's fascinating. And again, I'm talking about this about terms of investments, but it also applies to your life. He's saying, don't put all of your money into one stock. No, Mr. Blue. How you doing, still me? Yeah, of course you're still me. That's great. That's important. Do not put all of your money into one stock. That's what he's saying here. You need to break up that correlation. This is why the S&P 500 is such a genuinely good investment by and large. Well then I guess you're not Mr. Blue. You're Miss Boopla. If the S&P 500 has the top 500 stocks in the United States, as calculated by an algorithm that gets recalculated, I think. If it's not every day, I think it's every week. And why is that a good investment? Because you're getting these top 500 companies. You've diversified your risk so much. But they're the top 500 companies in America. If you look at the S&P 500 returns over the last 20 years, it averages about 10% or more, 12% per year. In many ways, if you know nothing about investing and you just want to make money every year, and more than inflation, just put your money into the S&P 500. But again, what does Ray Dalio talk about in this book? And generally, what we need to know about diversification is you cannot focus only on one asset class either. If you put all of your money only into the S&P 500, you're in what asset class? Stock market. What do you want to do? You want to diversify into real estate, crypto. You want to invest into a business, as our friend Carly was talking about before. That's another form of investment. Investing in gold, investing in platinum, other precious metals, investing in other currencies from different countries. Now, Ray Dalio, at least I'm only on page 87 here, or 57. He doesn't talk about all these different things yet, but the whole idea of a hedge fund is that you're hedging your bets by putting your money into various different high-risk investments. But what Ray Dalio did and why he's such a successful hedge fund manager, he said, no. I am not going to just randomly throw money at risky investments and hope that I make millions and millions of dollars for my clients. One of his first clients was the World Bank. And the World Bank is a sort of an offshoot of the I don't know if it's affiliated with the United Nations, but I know it's affiliated with the IMF, International Monetary Fund. And the World Bank had a pension fund for their employees. They gave $5 million to Ray Dalio. He turned that into $140 million. But he did not do it by taking huge risks. Would a pension fund, do they want someone to take huge risks and risk losing all of the pension money? No, absolutely not. The idea is, he said his whole idea as a hedge fund manager is he put a lot of money into something he calls betas. Betas like alpha, beta, gamma, all that. A beta was something that tracks the market. So the S&P 500 was a beta. So he put most of his investment clients' funds into betas that track the market, which means they're relatively safe. But he put a small portion into a big slew. A slew means a whole bunch of them. A whole bunch of risky in the fact that they're not certain, but promising risky investments that were spread out along many different industries. And that is basically the basis of his little holy grail concept. And as I've talked about many times before, this whole holy grail, this whole idea of diversification is something that you want to do absolutely in life as well. You need to diversify your friendships. You need to diversify your sources of income. Again, anyone who just puts all of their time and energy into one job, you are risking everything if you just lose that job. Or you become a slave to that job because you can't quit because That's the only source of income, which is, again, why I always tell people you need to, every time you get a paycheck, put money into your never touch fund. Or, in other words, and part of that never touch fund is your FU fund. And your FU fund, you can imagine what that means. So you can say that to your boss. If your boss starts to really upset you, and you can say, I'm not taking this anymore, I'm leaving. But how are you able to leave? You're able to leave because you've got so much money saved up in a diversified alternative space that's not linked directly to your employment. I want to read a couple of of quotations from this, and I'll read that to here. It says, you can read it with me. I was terribly fearful about what would happen if my assumptions were wrong, so I wanted to understand diversification in a very simple way. That's the first lesson about, again, people always think that, oh, you should focus. I'm so tired. I'm so tired of people telling people, you need to focus. Focus is the key to success. Only if you're right. If you focus all of your time, money, and understanding into something, and it was the right investment of your time, energy, money, and understanding, then guess what? It was a good idea to focus. But if you spend all your time, energy, and money focusing on something that's ultimately destined for failure, then focusing was the absolute worst thing you could possibly do. Therefore, again, I always run into problems when people, because I give these little speeches here and there, and people always fight me on this. They goes, why are you telling me to diversify? The only people who diversify are the people who don't know how to really invest. And I think that's gambling. You're 100% gambling if you're just focusing all your time and money onto something that you don't know for sure it's going to succeed. And so that's why diversification is the mark of a really good investor. Now, of course, you've got to diversify into many different likely investments. The success of maybe 40% of them can overcompensate for the failure of the other 60%. So again, you still have to do a good job, but diversification ensures you don't lose all your money. Let me read another quotation from Mr. Ray Dalio, his book, Principles. Whether you own a hotel, run a technology company, or do anything else, your business produces a return stream. Having a few good uncorrelated return streams is better than having just one. And knowing how to combine return streams is even more effective than being able to choose good ones. Just what I'm telling you right here. Let's say you have a steady boyfriend or girlfriend, or you're married, husband, wife. Maybe it's a good idea to make sure you develop some friendships with some other people in case things go down sour. You have other options. Don't invest in just one real estate rental property. It's better to have 3, 4, or better, 10. Don't invest in one stock, invest in 20 of them. Don't put all of your time and energy and money into one business, thinking this is the business that's going to succeed. I've seen so many people fail. They take their life savings, their 401k, their retirement, and they say, I'm going to start a restaurant because my restaurant is so great. My food is so good. And you have to always believe that you are wrong. You have to always believe that you are not as brilliant as a success picker as you think you are. And it's the same thing. I mean, I talk about this, you guys, all the time about even this YouTube channel, trying to figure out how the heck do I keep the channel growing? How do I get new subscribers? How do I get more likes? And I'm always thinking, how do I encourage more people to do the super chats and the super likes? And of course, that's an opportune point to make. If any of you guys want to support my campaign for famous, I'm running for famous. You can, of course, do that by becoming a member of the channel, youtube.com/Monroe Mann/join, or giving me a super chat, super thanks, or super sticker. Thank you so much. And I'm always thinking, how can I diversify? And I just found a cool way. I'm doing this Beatles concert tomorrow at 8 p.m. Eastern time. If you want to come check it out, I'd love you to come watch me play some Beatles songs. I did an experiment yesterday and this morning. I just recorded short 30-second videos of me playing 6 seconds of the beginning of one of the Beatles songs, and then just stopping and inviting people to subscribe to my channel and come to the concert. I was blown away. One video got 3 subscribers, the other got 7. And the beautiful thing is, these are shorts they subscribe specifically because of what I asked them to come to. I mean, I had the skydiving short, and I got lots of subscribers from that, me doing front flips out of an airplane. But my channel is only maybe 1% skydiving, because I can't take a camera on my helmet yet. I have to wait till I have 200 skydives. I've got 59 right now. So all those subscribers, maybe they're not really the people who are going to come to my live streams talking about finance or watching my music. But I just did 2 shorts playing some Beatles songs and inviting people to come to the live stream and subscribe. And they subscribe, which means I know they like my music. I know they like my voice. I know they like the Beatles. And I know they might be interested in live streams. So that's another diversified way of doing it. But I'm also going to get some subscribers, I hope, from doing this live stream right here. I always pass out my YouTube cards, so get some YouTube streams from there. The idea is diversify. You never want to assume. And especially with this YouTube algorithm that changes all the time. As soon as you start to figure out something that works on YouTube, YouTube changes the algorithm, or the audience changes their likes. My feeling is that the audience is not changing their likes as much as YouTube is changing the algorithm. My point is, you need to be on your toes all the time. And let me read this again, because this is important. Whether you own a hotel, run a tech company, or do anything else, your business produces a return stream. Having a few good uncorrelated return streams is better than having just one. The key there is uncorrelated. Like I have those YouTube cards. I just have them sitting there. So whenever I go outside on the street, I take some with me and I pass them out to people. That YouTube card is completely uncorrelated to the YouTube algorithm. It has nothing to do with it. If somebody joins my YouTube channel because of that card, it doesn't even matter about the YouTube algorithm, because they joined because they're going directly to my channel. Same thing. I want to make, as I told you guys, I've been doing YouTube as a professional now for about 2.5 months, and I'm making about an average of $250 a month. I'm very happy and proud with that. My goal is to get it to $4,000. But even when I get to $4,000 a month, let's assume that everything works out and I get to $4,000 a month of income, I'd be a fool to stop pursuing income streams from other investments. Because at any time, who knows? Maybe the internet goes out. Maybe Google goes out of business. Maybe Google gets broken up as a monopoly and YouTube gets spun off and then YouTube isn't successful anymore. Maybe people just don't like me anymore. Who knows? We don't know. So I'm always kind to think, and I'm trying to think, what can I do to, like right now, oh, by the way, I created a new PDF download on my store. So I don't think you can link to it directly from here yet. I don't know, maybe Google didn't approve it or something, but if you go to my store, so just click on the store here and then go to the store. You may have to go to it directly on Fourth Wall, but I have a PDF download, the 10 Myths of Investing. I'm going to try to figure out why it wasn't approved by Google and see if I can figure out, maybe I just have to change something. But we'll figure that out. Maybe it was just that it needs a 24 hours to get approved. But my whole idea is anybody that downloads something from my store or buys something, I get their email address. So if any of you guys do that, I get your email address. Guess what? Now I'm diversifying away from YouTube, because now I have your email addresses and now you're part of my fan list and I can still reach you even if for whatever reason I don't have access to YouTube anymore. Now let me look at some comments. I'm going to continue reading some portions from this book. All right. And Carly's still here. Booplop is this Monroe. All right, Free Alien lost 13,000 on ABC a few years back. What was ABC? Are you talking about ABC, the television station, or Alphabet, or which stock are you referring to, Free Alien? Booplop says safe investments. Remember, Booplop, there's no such thing really as a safe investment. Nothing is a safe investment because in any investment can turn to zero at any time. So you could say the safest investment is to have real gold. You got, $50,000 of real gold, physical gold, like gold bars that look like this. Well, if somebody steals those gold bars, how safe was that investment? It went from $50,000 to nothing. The stock market, that's the S&P 500. It's the safest investment in the stock market. But how safe is it? If the United States economy tanks, so does the S&P 500. If all 500 of those companies tank, so does the S&P 500. If the dollar has horrible inflation, that's going to infect the S&P 500. Boom, S&P 500 is going down. What else? Real estate, that's the safest investment. Well, what if you can't find a tenant for 5 months? And you can't pay the mortgage? What if it's coronavirus and the governments prohibit landlords from evicting people? That destroyed so many tenants during COVID. And some landlords had to keep non-paying tenants for 2.5 years. Some of them just lost their properties. They went bankrupt. It was absolutely horrible. So these states helped the tenants and bankrupt the landlords. I mean, how terrible is that? Robbing Peter to what is it? Robbing Peter to pay Mary, or robbing Mary to pay Peter, or whatever it is. Not good. But I'm telling you, there is no such thing as a safe investment, which is why, again, going back to what Ray Dalio is saying, the holy grail is increasing the number of assets or alphas in your portfolio. That reduces the likelihood that you are going to lose money in any year. If you got 20 investments, you're reducing it down to 11%, which is just, it's amazing. This is something I've always known for 15, 20 years, but it's nice to have a huge hedge manager confirm what I've always said about investment. Diversification is the key to success, even in life. People all the time have told me, Monroe, if you just focused on one thing, you'd be such a success. And people are telling me right now too, Monroe, stop with all this other stuff. Stop break diving, that company break diving. Stop doing your private investigation from Intertect. Stop working as a lawyer. Stop trying to work as a financial advisor, and just focus 100% on YouTube. And you would be so successful. That's the silliest advice I hear, and I hear it all the time. I hear it about anything. People say that, I say, Monroe, you should just focus as being a financial advisor. That is what's going to help. Monroe, if you just focused on being a lawyer. Monroe, if you just focus. No, for precisely all these reasons that I'm telling you here. If I focus on just one thing, the likelihood I lose money in a given year is, according to Ray Dalio's graph right here, 38%. I don't want to have a 38% likelihood of failure. And that's why any of you who just decide, I'm going to focus 100% on school, or I'm going to focus 100% on my relationship with my boyfriend or girlfriend, my wife, or I'm going to focus 100% on working for the government, or I'm going to focus 100% on making money in the stock market. All of those things, those are the worst decisions you can make. You might be one of the outliers, and you might be an anomaly, and magically become the 0.01% person who focuses on the exact right thing and become a success. And you go, Monroe Mann told me not to focus, but I knew if I focus. you can't take advice from the people who focused 100% and succeeded, because you never know if they succeeded just because of luck or market conditions or being in the right place at the right time. It's why I diversify everything that I'm doing. YouTube, my music, comedy, working as a lawyer, as a financial planner, as running two not-for-profits, because I am hoping that 40% of them are going to become skyrocket huge success stories that will become so successful that it makes up for the 60% of the other things that fail. The truth is, 99% of the things that I'm doing are likely to fail. That's just the case. That's the situation it is. And it's a good psychological way to look at things that you approach in your life. Expect to fail, but work your butt off believing that you're going to succeed. Because if you expect to fail, you're going to diversify. If you start a restaurant, but you go in your head, Monroe told me that the likelihood of it is going to fail, then guess what? You're going to do two things. You're going to diversify the offerings. You're going to diversify the different income streams from the restaurant to make sure you're not focused on only, like, think about it. What are the different ways you can diversify the restaurant? You can serve different products, different dishes. You can diversify the prices. You can diversify the locations. You can diversify the times of day when you serve. You can diversify, maybe no tipping allowed. You make yourself so different from everybody else. But beyond that, you can diversify, making sure you have other businesses, making sure you have other ways to earn money. Don't quit your job and say, I have enough money to survive for 3 months. I'm going to start my restaurant. You're an idiot. It could take 3 years before your restaurant succeeds, maybe 5 years. And even then, it may still fail. You need to make sure you've got something as a backup. And that backup it's not a backup in case you fail. It's a backup because there is a high likelihood you're going to fail. There's a book, Do What You Love and the Money Will Follow. Oh my gosh, how many people have gone bankrupt because of that advice? Do what you love and the money will follow. If you do what you love and you don't diversify and make sure you have multiple income streams, you will become bankrupt and the money will leave very, very, very quickly. How many people spend all their time pursuing a career on YouTube or TikTok or Instagram fame or becoming an actor or a filmmaker or running a tech company or starting an app or whatever? It's what I love. Or writing. 99% of people doing any of those things will never make a living doing it. The likelihood that I make a living from doing YouTube, the truth is, it's 99% likelihood I'm never going to get to $4,000 a month. But it was 99% likelihood I was never going to get the channel monetized. After 18 years, I figured it out. Awesome. But that's just one step up the ladder. Now the next step is, can I actually make a living from this? 99% likelihood, I will not. But there's a 1% likelihood that I can. That's why I keep pushing forward. But I'm still pushing forward with making money from multiple different sources of income. Maybe my law firm magically takes off like a rocket in 6 months. Maybe it's my financial planning practice. Maybe one of my books suddenly becomes a bestseller. Boom, and I make $1 million. Maybe one of my songs, maybe someone goes, dude, you got to come on tour with us. I go, okay, awesome. Great, now I'm on tour playing in a band. Who knows? But the idea is, do not assume that you're so smart that you have found the absolute holy grail that's going to make you a success. What is the holy grail? Diversification. The more assets in your portfolio, the lower the percentage likelihood you're going to lose money that year. Only 11% if you've got 20. Again, this is from Ray Dalio, one of the greatest hedge fund managers in the world. How you doing, Freddie Sawyer? Free Alien says, I like NVIDIA, Sophie, Palantir, Tesla, to name a few. I've heard of all of those. Haven't heard of Cake. I'm curious what Cake is, Free Alien. Still Me says, I didn't know the term hedge fund. I bought an acre of hedges, lost a lot of money. Yeah, I mean, if you don't know what a hedge fund is and you just buy green hedges on a farm, it's going to be a problem. Not really, it's not diversity, it's diversification. That's a big difference. And you don't want diversity so much, especially because that's got a political connotation now. We don't want diversity, because if you say I want diversity in my portfolio, that means I want to have black-owned businesses. I want women-owned businesses. That's the silliest reason to invest in a company, because of the color of someone's skin, or because of their sex. I deliberately do not. Anyone who advertises, there's this couple of these websites where you can invest in bonds or smaller businesses. Any of them that say invest in a black-owned business or invest in a woman-owned business, I will not invest in them. Because if they're trying to raise money based on an immutable characteristic that says nothing about that person or that company's ability to run a company effectively, I'm not giving you my money. I want to know, what's your return on investment? What's the likelihood that I'm going to see my money again? It's not a charity case. Now, the difference is veteran-owned businesses. Why do I think veteran-owned businesses is different? Because it actually says something about that person. It shows they went through basic training. It shows that they know how to handle authority. They know how to handle stressful situations. They know how to work with large groups of people. But if you're a woman or you're a minority, that says nothing about your ability. If any of you are women or minorities, I recommend you do not use that as a way to market your business. That's my personal thing. I know it may work. Many people may want to. There's a difference between getting people to invest for that reason and getting people to come to your business. Maybe if you say, hey, please support a women-owned business or a black-owned business, that's different, because maybe customers want to go in there and they want to support that. But don't make any investment decisions based on somebody's skin color or their sex. Not a good idea. Or even their nationality. It should be looking at the black and white numbers. And does this person have the managerial ability to take this company to success? And the truth is, since we're talking about race, and just because there's a white guy who's the head of a company, that does not mean that that company is going to be successful. I'm a white guy, and none of my businesses have become huge multi-million-dollar success stories yet. And it took me 18 years to get monetized on YouTube. So clearly, race and gender have no relevance when it comes to, is an investment a good investment or not? Okay, more messages here. Rent is expensive right now. Booplop, you were so correct. It's horrible. The fun understanding fun. I'm all out of focus. Free alien needs to get. You only live one stocks. Question, can one over diversify? Yes. There's a diminishing return of diversification. But if you think about it, look at the S&P 500. That's 500 stocks. And yet that outperforms the market in general, right? I guess you could say that, by 12%, you're going to do better. The market, goes maybe 4%, maybe even not. Sometimes the market goes down and the S&P 500 could still end up doing okay. But the difference is that you can over-diversify in the sense that the S&P 500 is managed by a computer. A human can really probably only manage 20 stocks. So maybe if you have a personal portfolio and you're actively managing them, maybe 20 to 30 is about the most you can have in them. But by investing in an ETF that's computer controlled by an algorithm like SPY, you can basically have 500 stocks and you're not over diversified because that computer algorithm is determining every single week what to do, and it's keeping track up to date. No human can keep track of 500 stocks up to date on a weekly basis without the assistance of computer systems and or a staff. So, and the other idea is, look, let's say you diversify into 1 million stocks, and you do a dollar into every single one of those stocks. It seems like that's silly. But if every single one of those stocks has a 100% gain that year, you now have $2 million. That wasn't over diversification. The problem is if you get to 1 million stocks and 950,000 of them all lose money. That's the problem. And the other 50,000 didn't gain enough to make up for the loss on those 950,000. So that's where you have, and again, so the idea is diversification is fine. You can buy as many stocks as you want, as many asset classes as you want, and as many industries as you want. You just got to make sure that you are choosing enough winners and that you're able to analyze these stocks to such an extent that you can make sure that the winners dramatically outperform the losers. So at the end of the year, your portfolio is up at least 10%, if not 15. And how cool if it could be 20 or higher, 30, 40, 50, whatever. Yeah, and Booplop gave a very interesting analogy. Booplop says she likes lobster fishing. You never put out one lobster pot. It's the exact same principle. If you just put out one lobster pot, maybe you put it out in the area where there are no lobsters. Or maybe that's the one lobster pot that gets cut. The line gets cut by a passing boat. Or some other thieves come by and steal all the lobsters from that pot. You want to make sure you've got multiple lobster pots. Diversification is the key. You just got to make sure the diversified choices that you make are predominantly winners. Okay. Or you choose one that's huge. Just again, imagine if you put back in 2016, you put $500 into the top 5 cryptos, let's say at the time. We know like Bitcoin was around there, and Ethereum, maybe that was around at the same time, and maybe 3 others. Most of them would probably not have done very well, but that $500 that you would put it into Bitcoin in 2017, boom, you'd be a millionaire right now. So again, it doesn't matter if all of your diversified investments fail, if one of them is a breakout hit, or if enough of them can make up for the losses on the other. But diversification is the key. Again, so many people say, oh my gosh, if only I had put $10,000 into Bitcoin back in 2016. How many people knew that Bitcoin was going to take off like a rocket in 2020? Very few people. And the truth is, I think the people who put their money into it, it was a gamble. They had no idea. None at all. Bitcoin could have been a huge failure. One of my friends, I had him on live stream. No, he was just in the chat room. He's a stand-up comedian, and he bought back in 2016. He did a comedy show, and he was offered like $2,000 in money or $2,000 in Bitcoin. And for some reason, he said, you know what? I'll take 2,000 Bitcoin. He did super, super well. But it was just he could have easily just decided, I'd rather take the money. But here's the thing. He was able to say yes to the 2,000 in Bitcoin because he was financially doing all the things I've been telling you throughout this live stream. Make sure you have a never touch fund. Make sure you have money saved in all different places. Make sure you have multiple income streams. Make sure you don't need the money from your employer. So he was able to say, you know what? I'll take a chance on this very risky thing. I'll take, 500, 2,000, whatever. He's not a multi-billionaire right now. I don't know. Maybe it was in 2017. Maybe it was a little bit later. But he still made enough where he was able to buy a bunch of real estate properties from it, and he's doing pretty well. But he was able to do that because he had money saved along the way. And he was able to take a diversified investment on something risky. Let me see. Google has Waymo. Jay says, what's your opinion on the global economy? It's looking up because I think my gut feeling now is I think Donald Trump is going to win the election. I am not a prognosticator. I don't know the future, but all these polls are showing that Trump is doing better in the polls. So I think the global economy is on the up and up. Right now, it's really bad, and it's a disaster. Inflation around the world is high. Inflation's bad everywhere. It's bad in Asia. It's bad in Europe. It's bad in the United States. And so I think most people are going to be voting with their pocketbooks, and inflation did not do well under this last administration. So I think we're going to see a change. Free Alien says Aurora Cannabis. I did what you're saying not to. I took 2,000 to 30,000, then they did a 10-to-1 reverse split. Learn what not to do. Just listen to me. Do not invest in one company. But Free Alien, I've made all the mistakes that you've made too. I've made horrible investments with options trading. I've lost money even doing covered call options, which is one of the most risk-free investments you can do with options. I now know how to do options trading that's more risk-free. But yeah, you don't want to put all of your money into anything. Like Aurora Cannabis it's a marijuana growing company or dispensary or whatever. That's very akin to Bitcoin. It's very risky. It could potentially soar, but the truth is, most of these, just on this side note, just since we're talking about that, most of these states and cities that have legalized marijuana, they're starting to change their laws back because the cities are starting to smell like crazy. People are just walking down the street smoking marijuana, and it's become a nose sore and an eyesore. And it's a trashy type of thing to do. Smoking is pretty trashy too. You see people smoking, it's not the classiest thing. I know they made very thin cigarellos. Do you remember those very tiny, skinny cigars and things like that to make things classy? But you're still smoking something, and it still has that connotation of not being a high-class thing. Well, marijuana is a very risky thing. It's still a federally illegal drug. It's only legal in certain states. So, it's a very risky investment. And I'm not saying that Free Alien made a mistake. I'm glad. I don't think you made a mistake in the sense of your education. As I mentioned, I bought this one stock, and I had thousands of dollars in it. And I made the mistake that we all do if we are really investing, of thinking it'll never go to zero. I've heard stories of stocks going to zero, but I'm thinking, no, this stock is great. I looked at the financial book. This stock went from like $22 to 20, 18, 17, 16. I'm thinking it's just temporary. I made a bad decision. I thought that it was all happening because of coronavirus. And it was, because all of their if you want to know what stock it was, it's SDC, Smile Direct Club. And they're based in malls. And I thought, as soon as Corona dissipates, they're going to come back and soar. They never recovered, and they went down to $5, $4, $3, $2, $1, 50 cents, 25 cents, and boom. It's not even listed on the stock market anymore. I lost all of my money. I lost all of it. But it's how I've become a better investor. And Free Alien, you are a better investor if you've learned from your mistakes of losing your money, your big investment by your 10-to-1 reverse, and losing whatever happened with that company. And I've learned my lesson, which is, every stock can go to zero. And it's why I've learned to diversify. That's why I know S&P 500, it could go to zero. 100% it can go to zero. Don't you dare put all of your retirement money into the S&P 500. Don't put all your retirement money into the stock market. Don't keep it all locked up in a home or homes. They call that home rich and cash poor. You don't want to have all your money in real estate, but have no actual access to money. That's another big mistake. What if you can't sell that real estate when you need it? Okay? Jay says gambling is a safe investment because you'll win eventually. If you quit, you could have got a jackpot on the next roll. Jay, it's an interesting way to think about it, and there are people where that has come true, where they lose $10,000 gambling and then they bet another $5 and they have a winning streak and they leave with $50,000. It does happen, but it's rare. You're more like, the thing is, you can become better at gambling by learning the games, and you can learn more about probabilities and this and that. But your skill is as a statistician and someone who has become adept at probability. Your skill is not playing the game, if that makes sense. With investing, you can actually learn not only how to increase the probabilities of success, you can actually increase your skill to the point where you can win repeatedly. I am not Ray Dalio. I'm not as good as he is, but I'm not a total nincompoop. I'm better than, I'd say, 90% of people who are investing. And why am I reading books like this one? Again, I'll show it, by Ray Dalio, Principles. Why am I reading that? Because I know I can make mistakes. Ray Dalio lost everything. He lost all of his clients' money. He made a big mistake. It was embarrassment. He had to let go of all of his employees. And he was going to give up. And it's a very inspiring book. And he actually had to borrow $4,000 or $5,000 from his mom. And that's an inspiring thing. I think everyone on here, at some point, you're going to have to borrow money from somebody. Might be your mom, might be your family, might be your friend, might be the bank, and you're going to feel like a total failure. Take solace knowing that Ray Dalio, the world's greatest hedge fund, he's now a billionaire. He lost everything, and he had to borrow $5,000 from his mom. And he was deciding, should I quit now and get a job, or should I keep going? And he kept going, and that was history. And he's a multi-billionaire now, and we're reading his book, and I'm doing a live stream about him right now. And it's kind of the same way that I felt about 4 or 5 days ago. Some of you guys know that I was getting really depressed, not getting as many viewers, not getting as many subscribers, and this and that. And it's difficult. And we all want to quit. But guess what? Don't. Keep going. And so free alien, or any of you, you're going to lose money investing. But you will lose a lot less money if you listen to what I'm saying and what Free Alien's saying, and diversify your portfolio, not only through the one asset in which you're investing in, but also across industries and across other assets and other areas. Otherwise, you are setting yourself up for a disaster. And let's say you do strike it rich, and you just magically choose the next Bitcoin, and you put $10,000 in, you end up with 5 million. Don't do what you just did again. Now is the time to diversify that $5 million and make sure you do not lose it. Warren Buffett's number one rule of investing, if you guys know Warren Buffett, he's CEO of Berkshire Hathaway, an amazing investor. His number one rule of investing is never lose money. His second rule of investing, see rule number 1. And that's why this is so important when we look at this. We need to lose, why is this not, okay. Probability of losing money in a given year, we don't want it to be 40%. We want it to get as close to 1% as possible. How do we do that? By adding more assets to your portfolio. Always diversify. What's up, Carly? Great to have you back. No, Booplop, you don't need money to invest in a meaningful amount to several assets in the first place. As I mentioned, I have this free PDF. It's in my store that I think you can access through my YouTube channel. If not, I will post that shortly so you guys can go check it out. And you can download it. It's a free PDF, and I talk about the 10 myths of investing. And one of them is you do not need a lot of money to invest. $1 diversified across 5 different stocks, guess what? You're in the game. You're in the game. And if you want to get involved with real estate, even with $1, you can get involved with a real estate investment trust through the stock market. Or there are plenty of these apps you can download that will allow you to do small $1 investments. And you get your feet wet and you start learning and you can start applying these concepts that I'm teaching you. Let me read another quote. In fact, I had some large collection of uncorrelated return streams. In fact, I had something like 1,000 of them. So, the free alien asks, can you over-diversify? Ray Dalio had 1,000 different streams, uncorrelated income streams from his investments for his clients. 1,000. That's what we're talking about here. Okay, here's some more. This new approach improved our returns by a factor of 3 to 5 times per unit of risk, and we could calibrate the amount of return we wanted based on the amount of risk we could tolerate. In other words, we could make a ton more money than the other guys with a lower risk of being knocked out of the game. In other words, a lot of these hedge fund managers would take gargantuan risks to try to make these huge returns for their clients, and 9 times out of 10, they lost their clients' money. Ray Dalio did an approach where it was 90% of the money was invested in betas, which are less risky investments like the S&P 500 that gives you steady returns, and only 5 to 10% was put into a large number of diversified risky investments. And boom, 90% of the portfolio was protected, and of that 10%, the returns were even greater than the 90%. That's how we turned the World Bank's pension fund from 5 million to 140 million. 5 million to 140 million. That's more than 20 times increase. Boom. Mind-blowing. Let's read more from our good friend Ray Dalio. A principle that applied to all parts of my life, making a handful of good uncorrelated bets that are balanced and leveraged well is the surest way of having a lot of upside without being exposed to unacceptable downside. That's what I'm saying. This concept of diversification, it applies to life as well. So even if you have no interest in investing, and I think you're a fool if you're not thinking about investing based on what I'm telling you in the markets and in financial assets, but even everything you do in your life, your friends, your real estate, your sources of income, the people you hang out with, the doctors that you go to. I know you want to have just one family doctor. It's probably better to have 3. What if one of them's not available? You know exactly who the other 2 are, who you love, who you can call. Okay. So, let me look at more comments. Oh, ACB was the ticker. Got it? Jai says you miss 100% of the shots you don't take. So you're right. But you lose 100% of the money on shots where you put all of your money that turn out to be failures. So you should take 100% of the different shots that make sense as investments and that fit into your diversified portfolio strategy. That is the big key. I mean, should you say no to some investments? Of course. Don't just say, I'm going to diversify and buy 1,000 different stocks randomly. That's really silly. And I always tell people to read the book, One Up on Wall Street by, what's his name? Peter Lynch. There's a book called One Up on Wall Street by Peter Lynch. Read that. And it teaches you how to pick stocks in a very simple way. But that's all it is. You don't want to just randomly diversify. You need to diversify only after you research your investments and make sure that they are a good fit to go into your portfolio. Jay wants to meet up in real life. I don't know who you are, Jay, and your photo's scaring me. You look like you're a worm. Uh-oh. Good night, Booplop. So 420 somewhere says, if you're young with bad grammar, why are you apostrophe RE, my friend? You need to also have a grammatical advisor. If you're young and have a decent job, get a financial advisor. I disagree with that in some sense, because not all financial advisors are correct. 90% of financial advisors work for a financial services company, and they're trained to only sell you what they sell. You go to an insurance salesperson, they're going to tell you insurance is what you need. Then they're going to say, oh, you need to buy this mutual fund. But you say, I want to buy this mutual fund. They go, no, that mutual fund's no good. And then you go, what about getting involved with real estate? No, you don't want to get into real estate. Now you go talk to a real estate broker, and you say, what's a good investment? They go, I think getting a multifamily property is a good investment. But they're not going to tell you anything about the S&P 500 in the stock market. You need somebody who's going. That's what I do, by the way. If any of you guys are interested, you guys can always hire me to be your financial planner. I don't sell anything, and I don't tell you to focus on any particular income stream. My job is to diversify you across pretty much every single income stream that's available, and to educate you enough so that you know how to do all this stuff. Never do you want too many people go and say, I've got money, I don't know what to do with it. So they go talk to a financial advisor and they know nothing. And not only does the person who has the money know nothing about money, those financial advisors often don't know anything about money. And it's the blind leading the blind. And you should become adept at managing your own investments. And that's what my whole website, Invest Like an Investor, is about. If you want to check it out, it's investlikeaninvestor.com. And you could read about my basic philosophy of investing. What's up, Carly? Carly's still here. Monk says Trump or Harris. Trump is the good one for the economy. Cake is Cheesecake Factory. Now that could be a decent investment, absolutely. Free Alien has a brain injury. Okay, you get words wrong. Oh, no worries. I think Free Alien, we've all got brain injuries. Big brain injury. That's why my forehead is so big. And that's fine, Free Alien. If you go with 10 stocks, preferably 4 to 5, everyone has got their own investment philosophy. And I'm not telling you that anyone's is right or wrong, but I am telling you that if you do not diversify and you only put your money in the stock market, that's a big risk. The risk may never, you may never have to pay the piper, as they say. But if the piper does come and all your money's in only 4 to 10 stocks and you got nothing else elsewhere, disaster. White Park says, what do you think of a Roth IRA? Yeah, I have a Roth IRA. I have 2 Roth IRAs. Do I have 3? No, I have 2. I have 2 Roth IRAs. And again, why would I have them 2? Because I don't want to keep anything in any one company. Even if you max out you don't want to max out a Roth IRA, in my opinion, with one company. Because what if that company, something goes wrong? I'd rather put it in different places. And again, it's just me applying my philosophy of diversification. Free Allen, have a good one. Thank you very much. Love to see you. Great to see you again. Again, I have my Beatles concert tomorrow at 8 p.m. I hope you guys will come. You're taking 2,000 to 38,500 right now. We're starting over. You're doing well. That's fantastic. Very, very proud of you, Free Alien. You know what's funny? I helped my mom with the S&P 500. All I did is take a bunch of her money, invested $40,000 a few years ago. It's worth $75,000 now. I mean, that's how good of an investment the S&P 500 is. As long as the U.S. economy is going well, you really can't go wrong with it. But going from 2,000 to 38,500, that even blows me doing my work with the S&P 500 out of the water. So, fantastic, Free Allen. Proud of you. Let's see, Free Allen. Some places just do asset allocation. That can be bad. Yeah, and again, asset allocation it could be good, it could be bad. The problem is if you don't understand, if you're not learning, if you don't know what they're doing for you, I think that's just a problem. How you doing, Yuraraka? Oh, Chaco. I'm doing well. We're talking about investments today. Wrapping up the live stream shortly, in about probably 5 minutes, but good to see you here. 38,000, not 3,800. Yeah. I see that. 2,000 to 38,000. I misspoke. It's incredible. So whatever you're doing, continue to do it. Just make sure that you're still diversifying, because as you've learned from Aurora, that could reverse. That could go the other way, and just make sure you're not keeping it all in the stock market. So, oh, Free Alien's somehow back. Free Alien, you said you were leaving. Now you're back. Good to have you. Yeah, but I'm actually leaving in a moment. Voice is getting a little sore, and I want to make sure I got enough to do my concert tomorrow night. Curious to see if we got any new subscribers from this. Honestly, my whole thing, we're talking about investments and stuff. I don't know what I'm going to have to do to get back up to having 30, 40, 50 people regularly on this live stream. Oh my gosh, it is so annoying seeing single digits when I was seeing triple digits during the summer. So weird. But it's a great lesson in what we're talking about here. You've got to diversify everything. So I was riding high and getting cocky, thinking, wow, I got 100 people viewing. Soon it'll be 1,000 people viewing, then 10,000 people viewing. Instead, it went the other direction. I've got 4 people viewing. So life is like that. And it's the same thing with your investment. So invest in the honest company. Look at you. I'll take a look at it. But I will tell you this, guys. Just as Free Alien said, he's giving us a stock tip. As I learned from the book, One Up on Wall Street, any stock tip you get is just, think of it as research the honest company as an investment. We don't know anything about Free Alien. You don't know anything about me, quote unquote. I'm telling you, invest in the S&P 500. Do your research first. Don't take my word for it. Don't take Free Alien's word for it. And yeah, Free Alien is doing that. Also, Sophie, do your own research. That's a good way to say it. Sophie, I think that's the app, the financial services app. So that's a good one. Again, a good one to do some research on. I want to thank you guys for joining the live stream. Remember, if you want to get my top 10 myths of investing, it's a free PDF download. Go into my store and check it out. And read the book Principles by Ray Dalio. He's one of the most incredible hedge fund managers, if not the most successful hedge fudge. He's a hedge fudge manager. And let me tell you, his fudge is delicious. A really great hedge fund manager. And I want you all to get started with investing. Please diversify all your investments, but make sure you're diversifying into investments that you believe could be winners. And of course, please subscribe to my channel. Please turn on the bell. And please come back tomorrow night, 8 p.m. Eastern Time. I'm going to be doing my Beatles concert, doing 10 awesome Beatles songs, and I hope you guys will be there. Let's see. Don't listen to me, just try and research Albemarle and Piedmont. Very good. I'll check those out as too, Free Alien. Piedmont and Albemarle. Thanks again, Monroe. You're so correct. My pleasure. It's great to have you guys here. Thank you for being a part of my live streams, and I hope you guys have a lovely evening. Bye, guys.